Oh, we're going to talk today about two different styles of jobs reports, two different types of reporting. We're going to break them down and talk about why this is devastating for the economy because of how the Federal Reserve is going to act. Sorry, I totally forgot my mouse. There are a lot of changes happening, and we need to make sure that people understand those changes because this is an ever-changing environment. The first story I'm going to go over when I'm talking about the jobs report is out of CNBC. It's entitled U.S. Job Growth Totaled 275,000 in February, but the unemployment rate rose to 3.9%. All right. Remember that the Federal Reserve, in order to get to the point where they want to lower rates, it's when the economy crashes. How does the economy crash? People lose their jobs, people spend less money. End of story. It is actually that simple. You don't need to be a mathematician or a Harvard economics professor to understand this. All right. It says here out of CNBC, and then I'm going to go over another very different telling style of reporting, okay, when it comes to this. It says job creation topped expectations in February, but the unemployment rate moved higher, and employment growth from the previous 2 months wasn't nearly as hot as initially reported. Non-farm payrolls increased by 275,000 for the month, while the jobless rate moved higher to 3.9%. Economists surveyed by Dow Jones had been looking for a payroll growth of 198,000. That's a big difference. February was a step higher in growth from January, which saw a steep downward revision to 229,000 from the initially reported 353,000. Job growth in December also was revised down to 299 to 333. So it looks like the job numbers back then weren't that great, and these revisions come out lower. It's interesting how they want to prop up the market. Everything seems great, and all of a sudden, a month later, they go, you know what, actually, we weren't right on those numbers. Here are the real numbers, and they're worse. Now, it says here the jobless level increased as the household survey used to calculate the unemployment rate showed a decline of 184,000 in those employed. The increase came even after the labor force participation rate held steady at 62.5%. Now, when we talk about the participation rate, I want people to understand that the government is counting part-time jobs the same as a full-time job. People are so underemployed, it's incredible. People need to wake up to the fact that if you are unemployed or you are underemployed or you are having a hard time making it right now due to inflation, a lot of other people in the nation are too, or in the world. Okay, we are crashing. I want to say real quick, I started a newsletter down below if you'd like to sign up for it. It's free. It'll keep you abreast of things that are going on, not only on this channel and updates, but I'm going to be able to send you links, direct links to to news articles that I can share, that I can share on an email that I cannot share here because the platform doesn't want you to leave. Okay, that's how it works. So everything sort of looks great, right? It says here, check this out. The job numbers likely keep the Federal Reserve on track to cut interest rates later this year, though the timing and extent remain uncertain. Now, I've told you before, we're going to see a little political move, I believe, where the Fed's going to lower rates a little bit. And it's going to be a false positive. People think that, okay, things are great. We're just going to keep sailing. The Fed's going to lower rates. It's going to go back down to what it was. It's not going to happen. The only way that happens is if we have an absolute devastating collapse in stock markets and the real estate market. Okay, that's the only way. But what they'll do is they'll give you a little bit of fluff, pull the rates back 25 to 75 basis points. And that's going to do nothing. They've done this 4 times since 1972. And then they're going to take them and moonshot them because they're still not on top of inflation. They have not seen, they want 8, 9, 10% unemployment rate. I know it sounds crazy, but they actually do want that because when that happens, people lose their minds, the banks move in and they buy up all of the assets. Now we're going to switch over to Zero Hedge. Check out Zero Hedge's story because it's like, this is all vanilla. That's what they give you. Like, oh, it's vanilla. Everything's good. Everything's awesome. It's not. This is Zero Hedge's stance on this. February jobs soar by 275,000, smashing estimates. But January revised sharply lower and unemployment rate jumps to a 2-year high. Death taxes and the Biden administration reporting a stellar jobs beat, then revising it sharply lower 1 month later. That was certainly the case moments ago when the BLS reported that in February, a whopping 275,000 jobs were added, smashing both the median estimate of 200,000 and a whisper number of 215. In fact, just one Wall Street forecaster, Sanjay Kastuhalata, at Daiichi, had a higher forecast of 286,000. And while February was a strong print, it's just a placeholder until next month's downward revision. That's because January's blowout 353,000 job print was revised sharply lower to just 229,000, down a whopping 35. So again, they're telling you here in this news story, they're like, look, these jobs look great. Oh, this is great. Everything's great. Biden administration, Build Back Better is great. But we're going to tell you the truth 30 days from now. This is the lie. This is how many jobs are created, so they can say it on the campaign trail. Look at how great this is. They're lying to you. They're going to revise it lower next month, just like they did with January's numbers and with December's numbers. However, as usual, there was an ugly divergence between the establishment survey and the household survey. So establishment survey is payrolls. Okay, that's legit numbers. Household surveys that's payrolls. Household survey are the actual number of people employed, which declined once again, sliding to 160.96 million from 161.15 million, or down 184,000 jobs. This means that the divergence between payrolls and employment extended as more people are forced to take on more than one job. Again, they're counting them wrong. That wasn't the only problem with today's report. Despite the sharp jump in monthly payrolls, the unemployment rate unexpectedly rose to 3.9%, the highest since January of 2022, versus estimates of a 3.7% unchanged print. Among the major worker groups, the jobless rate for whites was unchanged at 3.4. For blacks, rose 0.3% to 5.6%. Asians were flat at 3.4%, and Hispanics at 5.0%. We also saw discrepancy between men and women. On International Women's Day, the unemployment rate for adult women climbed by 0.3% percentage point, to 3.5%, while the jobless rate for men dipped. That said, the rates are now the same. While the unemployment rate rose, labor force participation rate was unchanged at 62.5%, disappointing expectations for a modest increase to 62.6%. So the average hourly earnings for all employees on private non-farm payrolls edged up by 5 cents to $34.57. Now that's the average hourly rate. Just curious, are you under or are you over the average hourly rate? I'd love to have you type it down below. We'll take a little poll right here. Just type over or under. In February, hourly earnings for private sector production and non-supervisory employees edged up 7 cents to $29.71. In February, the average work week for all employees on non-private, non-farm payrolls edged up by 0.1 of an hour to 34.3 hours, following a decline of 0.2 hours in January. 34.3 is the average hourly work week. So think about that. Is that enough to make it? Is that enough when you're calculating 34 hours times non-farm payrolls of $34.57 a week? Is that enough? It's not. Taking a closer look at the job comparison, we find that February job gains occurred in healthcare, in government, in food services and drinking places, in social assistance, and in transportation and warehousing. The fact of the matter is, and this is what I want to really drive home, the Federal Reserve is data dependent, and they always are. You're finding out the data when it already happened in the past, right? Because they're calculating last month's, last quarter's, last year's numbers. The Fed knows exactly the trajectory of this. And they're already coming and saying, oh, we're going to lower rates this year because they know that the economy is collapsing. And by the time, and all they have to do is the right news push to where everybody goes, oh, the economy's crashing. Okay, now we can lower rates. But at that time, you go to the bank and say, hey, I want to get a deal on something. And they go, sorry, we don't got the money to give you. We're crashing. Didn't you watch the news cycle? And then what happens is a major fast constriction of spending. And that just pushes this even farther and farther to the downside. So that's why it's just so darn important to be ready ahead of time. I hope you got something out of this. Thank you so much for watching. If you want to sign up for the newsletter, it's down below. The Real Estate Ninja is out.